This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
We have a great guest, really nice guy too, Ben. Professor Samuel Hartzmark joined us. Sam's a professor in the finance department at Boston College's Carroll School of Management, and he studies asset pricing and behavioral finance. And absolutely fascinating, engaging, really nice guy. So with that, Ben, you got to cue this up. These are great topics to talk about.
Yes, he's got tons of incredible papers, and I was familiar with a handful of them before we invited him on. And then afterwards, obviously, I read all the papers, at least the ones that we asked questions about. But it's just another case of you know what, it was a paper on dividends that I was most familiar with. And then a more recent paper on sustainable investing that Sam came out with. I read that one, and it was just so good. He does such a good job at really pulling apart topics in a way that, well, not intentionally, I guess, but he brings you these counterintuitive conclusions with his research.
Mm-hmm.
I guess he chooses topics that end up having really counterintuitive conclusions. So on sustainable investing, just a fascinating paper on the actual impact of changing the cost of capital of green and brown firms. Like if we're trying to make the world a better place, is depriving brown firms of capital an efficient way to cause a green transition. Anyway, very counterintuitive finding. I won't spoil it. But after I read that paper, I was like, oh, we gotta see if Sam will come on the podcast. And then once I dug into his research, there's even more interesting stuff on sustainable investing, on dividends. We spent a lot of time talking about those two topics, but then also about the impact of price-only index returns and how that affects investor behavior and how the media reports on markets.
And that's the subject. I don't think we've talked about that bias before. It was really interesting.
It's a thing that, like, it's a thing. I've had this conversation with people many times where they show me the returns of an index and they're like, why am I getting a different number than you? And it's like, well, you're looking at the price only return. So yeah, it's something that it comes up for sure, but Sam's done incredible research on it. And then we finished with a discussion on multi-factor asset pricing, which was very interesting. It was last year that we spent a lot of time talking about the ICAPM model, and then of course we've talked to Robert Merton, and we've talked to John Cochrane, and we've talked to John Campbell about the sort of risk story for multi-factor asset pricing. And Sam has, again, I'm not going to spoil it, he's got a really, really interesting take on how to interpret those models and how realistic they are given how people actually behave or people actually think.
So Sam holds a Ph.D. from Marshall School of Business at the University of Southern California, also has an MBA from University of Chicago Booth School of Business, and a BA in Mathematics Economics with a double major in religion from Emory University. Anything, Ben, to add?
No, I think this is a really, really cool episode. I hope people enjoy it. So with that as the introduction, I think we can go ahead to our conversation with Professor Sam Hartzmark. Professor Sam Hartzmark, welcome to the Rational Reminder Podcast.
Well, thank you so much for having me. Pleasure to be here.
Yeah, we're super excited to be talking to you. So Sam, to kick it off, how does Morningstar's sustainability rating system work?
So Morningstar's sustainability rating system and kind of how it's different from other rating systems is they every mutual fund in the universe, whether they were green mutual funds, normal mutual funds, and no one had really done that before. So what they did is they looked at the holdings of mutual funds, which are disclosed to Morningstar. They look at each of the individual firms, and then they use an ESG score for those firms. Morningstar uses Sustainalytics. Then what they do is they take the score, which is just like a number from, I think, 0 to 100. They average them based on their portfolio weights. And that kicks out a globe rating. So they rate everything within a category by percentiles, and they just do the classic Morningstar 1 to 5 that they do with the stars. So the bottom 10% are one globe instead of one star. The top 10% are 5 globes instead of 5 stars. But, you know, it's the same kind of take the top 10%, bottom 10%. Those are the really good. Those are the really bad, with kind of the same cuts in the middle.
How did the introduction of sustainability ratings in 2016 affect mutual fund flows?
So, you know, this is kind of the subject of a paper I worked on with Abby Sussman. And we were really interested to look at this because we knew that there'd been this huge inflow of green funds. So I think at the time, green mutual funds had grown to about 3% or so, 2-3%. From roughly zero a few years before. So there'd been this big growth, but there was this open question about, okay, there's kind of this fringe set of investors. Overall, what do people think about it? And that's where this rating system was really cool because it rated everybody. So it's kind of a market-wide shock. And we found basically that there was a big impact on fund flows. So those 5 globe funds that, you know, were the most sustainable, that highest rating according to Morningstar, they experienced really big inflows. And the 1 globe funds experienced really big outflows. So I think we estimate, you know, in terms of dollar amount, something like $25 billion flowed into the 5 globe funds, you know, slightly less kind of flowed out of the 1 globe funds. And that's really interesting because that has both people buying it, but also selling out of it. So it says on aggregate, like kind of the net flows were really towards these funds that were rated high in terms of sustainability. And so the introduction just had a significant effect on mutual funds on aggregate, very much in favor of the high sustainability funds.
It's super interesting. We recently talked to Zahi Ben David. This sounds a lot like his paper on star ratings.
Yeah. So Zahi's paper, which is spectacular, looks at like what happens when Morningstar shifts its ratings, basically, and finds that, you know, they were basically taking these big factor loadings when they weren't adjusting, and then they switched, and all of a sudden these factor loadings went away. I'd say our paper has a similar spirit of, I mean, Morningstar is this big influential rater. People really pay attention to them. They really respond to the ratings, and maybe they don't think too much in terms of the details, which is, I mean, it's what they're kind of selling, right? Like people like, this is 1, this is 5, and they respond to that. Yeah, I'd say Zahi's paper is similar in that they're looking at the star ratings on past performance, and we're looking kind of at the globe ratings.
Yeah. So how important were the globe ratings relative to more detailed information that Morningstar is also presenting, like the percentile rank of sustainability?
Yeah, no, so this is one of the things, you know, when I'm not doing green finance, I very much like think a lot about behavioral finance, display of information, things like that. And so one of the things that was super interesting with these ratings is Morningstar basically gave you all the information you could want in terms of details about what was going on in this rating. So they gave here's 1, here's 5, you know, these are the globes. But they also gave you the percentile rank within each category, which is exactly what the globes were based on. So were you 1, 2, 3, 4, 5, you know, up to 10, you were 1, were you at the top 10, you were 5. And then they also gave you the raw score that wasn't necessarily adjusted, of just kind of what was the average evaluated ESG score in the portfolio. And you know, there's a little bit of nuance, but to a first approximation, what we find is all of that detail that Morningstar really considerately provided didn't matter at all. People didn't pay attention to it. People didn't really look at it. People really focused on these 1 in 5 globe funds. And we can do some cool things in the paper to really show this, where, you know, we can have funds that were, say, just over the line on one side or just under the line. So they're about the same on, you know, sustainability, everything you can look at. And the ones that just tipped into those extreme buckets got big flows.
Wow.
only thing, I think people really disliked the absolute worst funds. So if you were like, I think I'm forgetting if it was 1 was bad or 100 was bad, but the absolute most extreme, people really didn't like that percentile. So there was a little bit, it wasn't that it was totally ignored, but economically, it was just this coarse, easy to respond to display, not any of the nuance. Now, in one other thing I don't think I mentioned in terms of the rating system that's kind of related to this, in where this is a really interesting system to study, there was no fundamental news that came out of this rating. So you might think that like Morningstar would go and do research and new information was created, and then maybe investors are responding to that. That's not what happened here. So they took existing ESG scores, took existing holding data, created these scores, and that's what was going on.
Incredible. Can you give us a sense of what motivated investors to allocate towards funds with higher globe ratings?
Yeah, so this was, I think an interesting question for us. So we went to the data, and this is, I don't know, it was a fun paper in that I didn't have a strong prior. Like we knew that ESG funds had been growing. At the time, there was a bit of uncertainty about market-wide dynamics. So, we kind of got the data and we found these huge flows. And then the question comes, okay, so why are those flows there? Well, we can rule out some things. So one story, especially at the time, was ESG is kind of an institutional game. Like this is a game that's, universities are being pressured to do certain things. And that is the type of things that are driving this movement. And, institutions are clearly important in this space. Because we're looking at kind of standard US open-ended mutual funds, it'd be strange if that was the clear driver. And we can also split into institutional and non-institutional share classes in our data. We find very similar patterns in that. So, the interpretation of that is, I would say that it is not being driven by institutions. What we then kind of were left with is, well, is it something related to outperformance? That people thought that these were, say, there was alpha associated with ESG or something like that? Or is this more about people who, for moral reasons, want to hold green funds, people who want to achieve impact, things like that? We could look for performance in the data. We did not find any evidence of overperformance. With our paper, you've got to take that with a grain of salt. We're looking at about a year. Returns are noisy. We find slightly negative point estimates that kind of green funds underperform, or sorry, 5 globe funds underperformed the 1 globe. But I would say that, your prior really matters to there, because this is not the paper to definitively say, green outperforms or underperforms. There's a big debate about that. But we didn't find any evidence of overperformance. So then the question becomes, well, is it about returns expectations, where these are just kind of better investments, or is it about environmental concerns, things like that? So the problem when looking at the data is that those should have kind of the same prediction, right? Like people flow into this, you don't find outperformance. So what we did is we ran experiments on both MBA students and then people on an internet kind of survey platform. And so what we found that was consistent about both those, and what we did is we showed them mutual funds, basically screenshots from Morningstar, and then we randomized the sustainability globe rating. So in all of them, I believe, were 5-star funds. So we tried to choose kind of similar funds that had different globe ratings and then randomize the globes across it. And then we asked people to allocate money to the funds that they saw. And then we also asked them about performance expectations. So what we found is kind of some evidence in favor of both. So those Booth MBA students and the folks on the internet all thought that higher globes were associated with higher returns and lower risk. So they just thought that these were better investments on some level. Now, what we also did is we looked at how those allocations shifted based on those perceptions of risk and return. And what we found was that people did allocate more money to the 5 globe funds than could be explained based on those expectations. And if you dug down even further, it was the folks who said, so afterwards we asked, like, did you care about environmental concerns when you made this? And the folks who said they did, those were the people who kind of drove that excess allocation. So the folks who said they didn't care about environmental concerns, they allocated more to the 5 globes. It was explained based on performance. So, you know, what I think that's about as far as we can go there is it seems to be some of both and a mixture. And I think this is I think what's going on in the market is some people think this is related to performance. Some people think it's a moral issue. And we're kind of capturing both of those things, which in the data push things in the same direction and kind of drive those flows.
What would the performance be related to a hedging demand, or is that something different?
So we did not ask for a hedging demand. So, you know, that is something that we could have done and has become more popular. So there's definitely papers now that are trying to say that perhaps people like holding, say low carbon portfolios, because in a world that's transitioning to a green economy, that's a valuable hedge. Now, if you thought that, and if you thought it was rationally priced, it should go in kind of the opposite direction, at least in terms of return expectations, where, you know, once lots of people are holding stocks as a hedge, that basically means today they're willing to pay more for that hedge and they should have lower return expectations going forward. So we didn't ask about that, but the return expectation numbers kind of go in the opposite direction.
Yeah, right. So the people expecting high returns would really be saying that they don't think carbon risk is priced properly if they have a hedging demand.
Yeah. And that's, I mean, I think a mispricing story in many ways is the easiest place to get outperformance of green stocks. If, for example, I think one of the papers that did show evidence of something outperformance potentially related to kind of like socially responsible investing is this paper by Alex Edmonds showing that employee satisfaction ratings predict excess returns. And I think that's what he would argue is that is a public signal that's informative that the market wasn't taking into account that was leading to this alpha. And I think that, yeah, that's probably the easiest way to motivate higher performance by green stocks. The countervailing fact, though, is the world has really turned to focus on like ESG investing. The idea that, you know, people aren't paying attention to these signals or systematically underpricing these signals, I think that becomes less likely, but, you know, could be.
Yeah, super interesting. We had Professor Edmonds on at episode 192, and he told us all about that.
Oh, yeah. No, it's a great paper.
Yeah, it is super interesting stuff. What are your findings in this paper that we're talking about? Tell us about what mutual fund investors care about.
You know, there's a few different bits. So one is, I would say, you know, one takeaway from the paper is, at least in this time period, mutual fund investors really did seem to care about a perception of sustainability. And they really responded to that. There was a large shift of funds consistent with that. And that just seemed to be, you know, a positive attribute for these funds and for these investors. I think it also speaks to the fact that, you know, these aren't necessarily the most deeply complex or thought out decisions necessarily, you know, and you can see this on a bunch of dimensions where, you know, this was public beforehand. So in a standard model, no new fundamental information is out there. So no flows should have occurred. You know, people aren't really paying attention to the nuance. If what you really care about is like a specific goal, it's kind of unclear as to whether this is the rating you should be looking at. But, you know, what is driving things? this very salient rating that was at the top of every Morningstar page that lots of funds used in marketing. That, you know, it was salient, it was attention grabbing. You know, it seems broadly something that investors responded to, but probably not in the most thoughtful, deeply nuanced way. And I think that's, you know, like Zahi's paper, I think, is kind of similar. Like, you know, Morningstar's ratings are hugely influential in terms of the star ratings. They're just like, it's a formula based on past performance. There's no new information that comes into that, but people like simple heuristics. They like complex data digested for them, and then they can kind of respond to it in a fairly simple way.
Interesting. What's the general idea behind how sustainable investing is supposed to make the world more green?
So I think the rough idea is that you want to shift the cost of capital of firms so that they can make investments to make things more green. And so, you know, at a broad level, you want to take firms that could end up doing better in terms of how you want to define things. Let's say emissions, something like that. So maybe they could manufacture something in a lower emissions if they invested in something expensive. And you want to allocate money and shift their cost of capital so that investment makes economic sense for them. Because if they were already doing it, you know, it's there'd be no reason to shift money around. So you want to kind of incentivize these firms to improve. So, you know, the cost of capital is kind of the way that economists conceptualize that idea, kind of like, what is the discount rate you use in order to make investments in future products better or worse? And so in terms of sustainable investing, the rough idea is you buy the firms who you want to, you kind of send money to those firms that you want to kind of become more green. By sending money to those firms, you know, you kind of allow them to finance the projects you want them to finance. And hopefully in doing so, you end up kind of making the world more green in the process.
Yep. Can make sense. Maybe I'll just say, actually, just for listeners, that you're talking about sending the money in the secondary market, so you're affecting their cost of capital, but not literally sending the money. I think that's a common misconception with ESG investing.
Yes. So sorry. And there are versions of sustainable investing, you know, like the green bond market or something like that, where it's directly investing. But this is more, yes, kind of you're on the secondary market influencing cost of capital. So, you know, there are in the major way we think of that is, yeah, you're shifting around share prices. Of course, you know, if share prices are increased a lot, firms can issue more stock, and like there's some nuance, but yeah, we're talking I think we're going to the paper I've got with Kelly Shue, which is mainly thinking about kind of, yeah, equity investing, though you know, similar with bonds as well too.
Can you talk about impact elasticity in this research?
Yeah, so the like we'll quickly take a step back and I'll get to impact elasticity. So like what Kelly and I were interested in this paper is, you know, there's a lot of different things that go on in terms of sustainable investing and things along those lines. But truthfully, there's some big themes, like dominant ways that things are implemented. So one of those is how do you implement a sustainable fund? If you're just like a standard sustainable fund, well, you buy green firms and you sell brown firms. And that's the standard strategy. There are other things that are out there, but that's really what most people tend to do. And, you know, most people tend to kind of focus on emissions because greenhouse gas is just this huge overarching issue. And then most people want to kind of move the economy to a green economy. So they both want to make kind of emissions lower, but not destroy the economy while doing so, kind of achieving green growth or a green transition. So that was kind of the starting point for this paper. And we were kind of like, okay, so let's say that happens. Let's say sustainable investors who want to transition to a green economy, who care about lowering emissions to fight greenhouse gas, buy a lot of green stocks, kind of low emission stocks, sell a lot of brown stocks. What would happen? Well, I think the first order question is, well, okay, how will these firms respond to these shocks to cost of capital? So the green fund or firms that are being bought, they are going to be able to make green investments. And so how much will their emissions change? We look at emissions intensity, which is kind of emissions scaled by revenue. And then the brown firms who are going to have capital kind of shifted away from them and are going to kind of be pushed towards financial distress and not as good, how are they going to respond to that? And so the impact elasticity that we're thinking about is just the answer to what happens to firms when you get shocked in terms of your cost of capital, in terms of your emissions intensity. And then, of course, the next step is, well, how is that different for green and brown firms? Because that's what you need to know to answer the initial question, right? Like, if these investors actually shifted the cost of capital, what would happen? Well, you're going to shock the green firms in one way, you're going to shock the brown firms in another way, and that should kind of dictate your answer to that question.
So how are the impact elasticities between brown and green firms different empirically?
So they are quite different, and we find an impact elasticity of roughly 0 for green firms. So what that means is if you're a green firm and your cost of capital is increased or decreased, you kind of sort of keep on doing about the same. If you're a brown firm, we find a big negative impact elasticity. So what that means is, let's say lots of sustainable investors shift capital away from brown firms, decrease their share price, they end up emitting a lot more. And then when brown firms are doing quite well, that's actually when they manage to cut emissions, at least in terms of emissions intensity. They tend to kind of produce things in a more environmentally friendly manner.
Crazy. Well, what's the intuition behind that?
So I think the intuition is kind of just thinking about these different firms and who they tend to be. So I think the green firms are the easiest to think about. So if you think about who are these green firms, these firms with super low emissions, well, they're firms like insurance firms, healthcare firms, to some degree tech firms, and they have very, very low emissions. So in our paper, we use an example of Travelers Insurance, who per $1 million of revenue, they emit, I think, about 1 ton of greenhouse gases, which is about 40 times less than the average US household. And what's going on is, well, they're an insurance firm and they can do things on the margin to get more green, but even if they really were to go incredibly brown and, I don't know, buy everyone used cars with no catalytic converters or something like that, there's just not that much that they can do to get worse, and it's not that much they can do to get better. Now, the brown firms are kind of the opposite of that. These are firms, these are agriculture firms, building material firms, energy firms, who are working in businesses and kind of business types that are emissions heavy. Like, if you're going to make cement, the process just releases a lot of gas. But what those types of firms, the constraints they're working under is they can either, make investments that probably are very costly up front, but likely will pay off over the long term in results in lower emissions, or they can kind of say cut corners today, keep doing what they're doing, and likely emit a lot more. And so a firm like that, if you say have green or sustainable investors who say push it towards financial distress, well, I mean, they're not going to then make costly investments in abatement technology. they're going to kind of do what they can to survive the short run. And so those green investors have kind of forced them to be more short-termist. But of course, the goal is to get them to focus on the long term in the future. And so there's a bit of a contradiction kind of at its heart there.
Interesting. So it really doesn't incentivize brown firms to turn green. It kind of incentivizes them to survive.
Yeah, no, exactly. Intuitively, I think that makes sense. If when can you invest in the new technology for better production? Well, when things are going well.
This is all so interesting. Based on your findings, Sam, how effective has divestment of brown firms been at promoting a green transition?
So I think there are two bits to that question. One is, how big has the shift of cost of capital actually been so far? And that is an incredibly interesting question that is complicated and difficult to answer, that other people have tried to do. And we agnostically throw up our hands and say, I don't know. But you can choose your favorite paper there. Now, what's kind of interesting with that being said, and so there's this debate saying it's either shifted things a bit where green firms, have been able to kind of make green investments more, brown firms not, or it hasn't shifted it much at all. Again, interesting questions is about why, because the dollars flowing that way have been quite big. But what our paper suggests is maybe the best case scenario is where all of this money has been flowing into these kind of green investments, but hasn't actually shifted the cost of capital yet. Because if you kind of take our results with impact elasticity seriously, it suggests that it could have a counterproductive effect relative to this green transition goal. Yeah.
So you were mostly looking at divestment. How do you think your findings would change if you looked at ESG integration instead?
So I think that ESG integration would have a very similar intuition to what we're finding. And truthfully, it's something that in the next draft, we're going to kind of write up a bit more, because we've written it. I think the intuition of exclusion is very straightforward, right? And so we've kind of written it using that language. But the integration idea of just overweighting or underweighting, using ESG as an input more holistically in your portfolio, I think everything roughly holds in terms of what you'd expect in terms of the economic impact, influencing the impact elasticity, economically, why you think it might shift around firms' behavior. So I think that, almost anywhere in the paper we talk about avoiding brown firms. If you just say, overlaying an ESG strategy and taking it into account in your portfolio weights, would lead to a similar intuition.
So I have to ask the question that I'm sure many listeners have right now. So if somebody wants to have a positive impact on global sustainability, where should they be allocating their capital based on your research?
So that's a very interesting question. And I don't have specific, funds, but I think there's some broad things that our paper points to that investors can focus on. So one, and I'd say this is a general theme, both with green finance and also some of the later papers we're going to talk about, is try to be clear about what it is that you're really trying to achieve. So if you are an investor who, say, buying sustainable products for moral reasons, I think the answer might be different than, say, buying sustainable products because you want to have an impact on the environment. So if it's, say, moral reasons, maybe it makes sense to kind of focus on, exclusionary rules for, that are aligned with your morals. In terms of impact, I think you probably want to be focusing to some degree on firms that are actually engaging, funds that are actually engaging with brown firms, because at the end of the day, that's really where the improvement has to come from. And there are some exceptions where maybe funds that currently look green in terms of emissions someone who is kind of really focusing on impact would invest in. But in general, the improvements need to come from those brown industries. So, agriculture is a big emitter. If you want a green transition goal, you both want to keep feeding people and you want agriculture to emit less. And so you would need to really engage with the agriculture industry and find firms that maybe were relatively more green within agriculture, try to grow those firms, try to incentivize them to become more green, maybe avoid the firms that aren't doing that. But you can't just say, ignore all of agriculture and expect the insurance firms to kind of make up for the lost food.
Right.
That would be bad. Also, there are certain things that green product or sustainable investors seem to be trying to do, but aren't doing very well. So, something that could make a lot of sense is to kind of invest in firms that are actually improving. You're kind of trying to incentivize to them to improve. They do better. So one of the things our paper shows is that it looks like green funds try to do this, and also ESG ratings, but they don't do it in the right units. So they actually look at percentage changes in terms of firms that have improved as opposed to shifts in levels. Now, this is a big mistake because the brown firms emit like well over 200 times a higher emissions intensity than the green firms. And so if you treat 1% the same across each of them, well, the green firm that's having an impact, the brown firm that decreases 1%, that's much bigger in terms of helping global warming than an 100% impact on the green firms. But it turns out that people are basically focusing on this wrong unit. So
that's so interesting.
But those I'd say are the big things is, try to engage, definitely think much more within product, within industry. And if you're going to reward for improvement, use the right units.
Wow. Yeah. Super interesting. That paper is just, I'm sure ESG investors will find the paper very difficult. I think it challenges a lot of what's out there, right?
Yeah, no, and I think too, it's really important. Like, these are really important issues. And I think that people rightly have big concerns and really, would like to be doing things to, improve the environment, to combat these, global warming, these just massive issues. But because of that, I think it's also really important to think hard about, well, how do we actually do that and empirically look at what's going on, and hopefully improve the strategies and hopefully improve the impact it has in the process.
All right, I want to move on to another topic that people also get very emotionally invested in, which is dividends. Can you talk about how investors treat price returns and dividend returns differently?
Absolutely. Yeah, no, dividend investors are very emotional investors. I actually had another finance professor who I was presenting one of these papers, and he went home to Christmas, and his father-in-law was a big dividend investor, and he was convinced that our arguments would convince him. And he reported back afterwards that they agreed to disagree, that it was too passionate, the love for dividends. So emotions run high, but how should people, the question is, how do people actually treat prices and returns differently? So the first thing to note is that, like, before we bring in important real world things, they shouldn't be treated differently at all. So this is like a classic finding from the 60s, whose rough intuition is correct. So, you've got some sort of a dividend payout. Let's say it was worth, stock's at $10, it's going to pay a dividend tomorrow. Well, tomorrow that stock will be worth $9. You've got $1 in payment. You're not richer or poorer. You still have $10. If it wasn't paying a dividend, you could have sold $1 of the stocks. So you should be, it should be irrelevant. And then you bring in real world things like taxes and trading costs. for most US investors, most of the time, dividends will have a little bit of a tax penalty. So if anything, you should probably not necessarily love them. But so how do people actually treat them? Well, they view them as different and not together. And that leads to a big mistake because, think about what I just told you, right? Like the thing was $10, now it's $9, you got $1 in cash, you're better or worse off. But if you view, say, dividends as separate, well, you've got $1. This is awesome. This is free money. This is income. This is something you can live on. And firms kind of play this up. So they, pay dividends in nominal amounts. They try to keep them at levels where they can kind of always pay that amount, maybe slowly increase it. So it seems like a safe, stable, nominal income stream. And there's the price changes. And that's, what we think of as in terms of stocks. It can go up. That's awesome. It can go down. That's sad and risky. But you've got these kind of one thing you're holding, it's a stock, and you view it almost as two distinct assets. This risky price change component in the dividend component is kind of a safe, stable income stream.
Between us, Sam, what causes people to believe dividends are so special?
I think that some of it is that if you aren't paying particular attention, it's not very easy to kind of directly identify this theoretical idea. So first off, empirically, it's totally the case that when the dividend gets paid, the price drops by roughly the amount of the dividend. And there's a big literature in the 70s looking like it's almost the whole amount related to taxable stuff, things like that. But it's like intuitively, the price drops by the amount of the dividends. This is just true.
Yep.
But that's true when I've got a data set of like 10,000 dividend payments and I run a regression, and you get this coefficient close to 1 with a t-stat of like 30. But, I'm some investor who's just looking at the 5 stocks in my portfolio. Well, stocks are really volatile. And so in practice, what happens? Well, you get, a couple of basis point dividend payment on a day the market moves 2%. You have no idea that how should you think of it as a rational person?
Yep.
Well, you should think of in the counterfactual world, market's down 2%, but it would be down, 2% minus those basis point dividends if I hadn't received the dividends. But you don't really see it. And there's not really an effort to make you see it. So if you think about your brokerage statement, what happens with every brokerage I've ever seen is you get a dividend payment and it just shows up in cash. And it's not very salient which stock it came from. It's not salient that the price of that stock should be higher. So, if you aren't thinking about it, it looks like free money, like this volatile price has moved around. You don't notice where it came from. And that's why we call this the free dividends fallacy, that you kind of view dividends as this free bit of money that's distinct from the price level, as opposed to the price dropping by the amount of the dividend, which in practice is exactly what happens.
Yeah, that's crazy. So it sounds like a lot of it's related to salience, where the dividends are salient, but price changes are kind of obscure.
Yeah, no, totally. It's again, things, I think a lot of finance in behavioral finance are things that are obvious when you have the big data set and are obvious when you think about the theory. But when you're, sitting there with your app and your brokerage statement, aren't obvious at all. And it's just not very salient. It's hard to find kind of like, what should people be doing? Well, they should be looking at how much more money you have. And we've got a measure of that. That is the total return, where you kind of consider that dividend payment because it's all just a pot of money. We want more money at the end. We know how to measure that. But then, go and look at your brokerage, like go and open any finance textbook, and like page 1 will be like, this is a return. This is how we think about stuff. And then go and look at your brokerage statement and be confused that there's no return on there.
Yeah.
And that just kind of makes the real world a lot more difficult.
That's super, super interesting. We rarely have conversations with clients about their income and their capital return because we report on total returns.
No, it is. I'd say that is improving. Like it is now easier to find that information. where was it? We have in one of our papers, we kind of looked, and there was I think it was Interactive Brokers now reports total return in addition to the other things, but it was in their marketing that they did this. Like, it's like, we do this, it's a competitive advantage that other people don't. And even sophisticated stuff. So maybe things are different. This was a few years ago, but Bloomberg terminals used to ship with the default being kind of price changes, and you could flip things into a total return thing. So it's like, it's not that it was hidden or anything, but the standard is just often price changes and dividends separately, and that's how they're shown, and people respond to price changes and dividends separately.
Are dividends a safe hedge against uncertain fluctuations in price?
No, absolutely not. But, again, people kind of think about it that way, right? Because you've got, if you view a dividend as separate, then all of a sudden you can view this as kind of a stable asset that's uncorrelated with the price level of the stock. But because the dividend payment comes out of the price level, it's not a hedge at all. It would be like saying, okay, I've got $10 in my right pocket. I'm going to put a dollar bill in my left pocket. Now I've like hedged something. And it's like, no, you've still got the $10. So it appears that way, but it really isn't. And then, of course, at the extreme level, when prices actually go down a lot, that is when dividends do get cut. So it's really not a meaningful hedge in any way. And this is, I think, at the end of the day, all of this is kind of coming back to the same concept again of like, well, we know how to look at things. Like we look at things as returns because that's the economically meaningful way to do it. If you don't put these things together, all of a sudden you can start thinking about somewhat nonsensical things like this thing that's coming at the expense of price being a hedge against the price, which doesn't make sense.
Okay, I get that, and you just said that it's not a hedge because it comes out of the price, which makes sense to me. I've tried to explain this to people, like we talked about earlier, with very, very emotional dividend investors, and it's really hard to get across. Do you have a way to explain this to someone in a way that's easy to understand?
The hedge one is hard. I think I've now gotten pretty good at explain it. Like, so I think the base intuition of prices and dividends, like I think something like the analogy I give with like, you've got, say, money in one pocket, you shift it to the other. I think that is helpful. I don't know about the hedges in particular. That one I've had less folks focus on in general. But I mean, one thing that also makes dividends really hard. Why are dividends so hard? So first off, people love them, so it's emotional. It's not very salient, so they kind of get it wrong. Then it also gets conflated with other things that could be reasonable related to the characteristics of dividend-paying firms. So there is a fundamental difference between, say, holding a stock because it's a firm that pays dividends and you like that for some reason. Like, you could view it as a signal of ongoing profitability, or is a value signal, or, any number of things that I'm not saying that's good or bad, but that is a coherent thing you could say. Like, I believe the dividend paying firms are a good, safe investment. You could argue they have alpha, and I want to hold them that way. And, we can debate, do they have alpha? But that's coherent, as opposed to, I really, like, this firm announced they're going to pay dividend next Tuesday. I really want to buy the stock today so I can get the dividend. And what I found is that I can start to debias that, like, they're going to pay Tuesday, you shouldn't want it. But people then fall back on, no, but like dividend paying firms are good investments or good firms. And then you've got to explain, okay, maybe they are, maybe they aren't. But if they are, and you're, say, a taxable investor, you probably don't want the dividend payment. So like maybe you want to hold the dividend paying stock. Maybe that's your portfolio. In maybe you aren't an active trader, so maybe you still will receive it. But you shouldn't view the dividend as this like extra benefit you get. It's like, you know, something that if for most investors is probably a tax hit that you want to avoid. But
You know,
it all gets
it's
muddled is what I've found.
100%. You're so right, because people exactly fall back on the argument that no, look, dividend stocks have outperformed the market, and then when you try and say, but no, they don't have a 5-factor alpha, and then it's just dead. The conversation can't go anywhere from there.
Oh yeah, but then you'll get like, you know, they're good firms, they're safe, they outperform the market, and therefore the dividend's a hedge. And you're like, you know, like the dividend payout's a hedge. You're like, no, but now we've just like broken that dichotomy of like dividend payment versus dividend characteristic. Yeah, I feel like I've lost years of my life trying to explain this, but it's really tricky. And you know, I think a lot of these behavioral finance type mistakes, you know, one of the common themes is that these are things that if you write down the finance model, they're obvious, right? Like Miller and Modigliani is right. You know, we need to add in real world frictions. And sorry, that's the dividend irrelevance paper. I don't know if I said that earlier, but then if you go to like a class of MBA students and start talking through this, you start getting like pushback to those ideas, and you really see, no, like the core intuition is just wrong. And you know, even common usage. So our paper, you know, the Americans frequent flyer program is the dividends miles program, like, or they may have rebranded, but it was like, why, you know, why is that? Well, because dividends are awesome. This is the free money you get from flying. It's not, you know, they didn't mean this is like the tax disadvantaged irrelevant program. They meant this is the free stuff program. And that's how people think about dividends in frequent flyer miles and in the market.
Wow. When is the demand for dividends highest?
So there's a few different reasons why people demand dividends. You know, I think it comes back to that first question. So like, let's think about if you have the kind of wrong belief that dividends and price levels are separate, you suffer from this free dividends fallacy. So price changes are this kind of risky bet, and dividends are this kind of safe, stable, nominal income stream. So if you view the world that way, you're basically going to like receiving dividend payouts more when that safe, stable income stream looks better. So when does it look better? When the market's doing poorly, it's going to look better. In our paper, maybe the only time people didn't really like dividends was the tech bubble. That's like the only time we found in the last, I don't know, we looked at 40, 50 years or so, where it looked like, you know, there weren't systematically dividend investors, which I was not active in the market then and didn't really pay attention. But everybody I've kind of talked to seems to be like, no, it makes sense. No one cared about dividends in the tech bubble. And our data kind of bears that out. But so the flip side is when the market's doing poorly, clearly you want the safe, stable income stream. Also, when interest rates are really low. So you're kind of viewing this, again, wrongly, as this independent payout, almost like a bond coupon. So when interest rates, you know, went towards zero, demand for dividends just went through the roof. And then the last thing is you kind of want this safe, stable, nominal income stream. So the safer you view it, like as long as you think it will keep being paid, or maybe if you think it will even grow, you'll like that even more.
How does a preference for dividend yield affect the expected return of dividend paying stocks?
Yeah, so I mean, one of the things that's kind of interesting when you think about the reasons that dividends appear better or worse, they're going to be systematic. And in general, any sort of behavioral bias, or most behavioral biases, I should say, that result in, say, price impact are going to be systematic. So the interest rate's low for everybody who kind of suffers from this free dividend fallacy and wants to get this dividend income stream is going to want to hold dividend paying stocks. So what does that mean? Well, the price of those stocks is going to be bid up at the same time. And so, kind of what we found when we look at the data is, low interest rate periods, things like book to market ratios, price to earnings ratios, things like that. Dividend paying stocks relative to non-dividend paying stocks look much more expensive. And then we find that, basically by doing so, you're shifting the valuations and you're shifting expected returns. So right after these periods where everyone's kind of piling into dividend paying stocks, returns to dividend paying firms are significantly lower. We find about, say, 2 to 4% per year, kind of in the period, moving from periods of high dividend demand to low dividend demand is kind of that calculation. So there seems to be a pretty sizable shift in terms of demand that does shift around valuations and does tend to lead to kind of underperformance after very high dividend demand periods.
Wow.
Those are big numbers.
Very big.
Crazy stuff.
Yeah.
We talked about salience earlier. Can you talk about how mutual funds exploit the preferences of dividend investors?
Yeah. So, if you think of the Morningstar ratings, like Morningstar is not necessarily getting a benefit out of the salient fact, but you could think of, there's something big that investors respond to that lacks some nuance. So you can give that to investors. And maybe if you are trying to maximize your profits, kind of do other things behind it that investors aren't paying attention to. So if you're, say, someone who really likes dividend yields when buying, say, a mutual fund, well, that's kind of a weird thing. So for a firm, there's all sorts of economic things that could be going on. So we talked about why, say, a dividend payout shouldn't be liked, but maybe there's characteristics of firms, things like that. Now, mutual funds are just pass-through vehicles. So they, are just pots of money that hold assets. And so they receive dividends and they pay those dividends out to investors from their investments. Now, mutual funds tend to report the dividend yield on their fund from those dividend payments. Now, what makes mutual funds interesting is they aren't limited by any means to that amount of payment. Because in order to call something a dividend, they've got to have received it and pay it out. But they're a pot of money. They could always just send more money if what investors wanted is more of a payout.
Yep.
In that same Miller and Modigliani intuition holds of like that payout leaves the fund drops by the amount of the money. And so there's no reason why, a fund with a 2% dividend yield couldn't give 4% money out. And as an investor, it's not clear why you should prefer like a 4% dividend yield to a 2% dividend yield or something like that. With that said, investors love dividends and, they tend to get shown dividend yield, and investors could be making decisions to buy mutual funds based on that yield. Now, where this gets interesting in terms of providing a salient characteristic is so if you're a fund, you can increase that number. So you can either just say hold dividend paying assets, which is I think what a lot of people tend to have in mind in terms of what that dividend yield is capturing, but you don't have to do that. So you could start trading with an eye to when those dividends are being paid out and start systematically trading to increase that dividend yield. And in doing so, you will increase the number that gets shown on that Morningstar page, the prospectus, things like that. Now, you haven't made more money, you haven't done anything like that. But if investors were going to respond to that, that is something that you could actually be doing.
How much does dividend juicing cost investors?
So, it costs a pretty sizable amount for a few reasons. So the most direct thing is just tax costs. So, for most investors who are taxable, you're going, the specifics matter a little bit in terms of your level of capital gains, because qualified dividends, you pay a tax on the full dividend amount, but at a lower rate than capital gains. If you're at a massive capital gain, this intuition doesn't hold. But for most investors, you would rather sell $1 worth of stock than get it through a dividend, because you're going to pay tax on the full amount of the dividend versus only the capital gain on the stock you sold. Now, if you haven't held it very long and it's non-qualified, then that goes out the window. You're always better off selling some stock. So just in terms of taxes, we kind of have a back of the envelope calculation from firms who are doing this juicing. We estimate a lower bound of about 60 basis points per year in terms of tax penalty. And that doesn't even begin to take into account things like the funds that are juicing are trading a lot more, which is going to cost you money. They also charge higher fees, which are going to cost you money. And we don't find any return outperformance. I think the paper finds slightly underperformance as well, too, which intuitively kind of makes sense. You know, these are funds that are providing an economically nonsensical characteristic to a set of investors. If what you're really good at is saying providing alpha or something like that, that's not going to be your clientele. You're kind of catering to a slightly more unsophisticated crowd. What you're good at is selling these characteristics, and your funds end up being more costly, you know, on ways that are more profitable to the funds. But also, you know, a lot of these folks are probably giving 1% to the IRS, not even to the fund manager. So there's some big costs associated.
It's so crazy. We heard about salience being sold through structured products from a past guest and through thematic ETFs. It's like these salient attributes are expensive.
Oh yeah, no, and I think the structured product is another great example of like there are so many like headline things that people like, right? Like, you know, a capital guarantee. It sounds great. In the same way, like a dividend yield, like higher is better. But, you know, for the structured products, no one ever goes, what am I paying for that capital guarantee? And you know, except the hedge fund on the other side who's pricing it and doing quite well.
All right. On dividends, do you have any final words of wisdom for our listeners?
You know, so I would say words of wisdom is to first off, really think through the logic and don't dismiss the fact that a dividend payout does not make you richer. And I'd say that is the first order thing. And it's really hard and it's really tricky. Many people will be on the internet trying to sell you something otherwise, but like that base intuition holds and is true and is what's going on. In the second aspect is like, we really do understand what number you should be looking at, which is some number of total returns, and could be more complicated, you know, after tax total returns. You know, there's further modifications, but as much as possible, try to make sure you are focusing on the right number. And then lastly, make sure you aren't conflating dividend paying firms as a return predictor versus dividend payouts. So, you know, dividend payouts themselves are irrelevant to tax disadvantaged. And that fact is irrelevant, or sorry, not irrelevant, is orthogonal, not related to, you know, should I think of dividend paying firms as a good value proxy or profitability proxy or something like that? That's just a totally separate question that shouldn't be conflated.
Yeah, that's great. That was a great segment on dividends.
No, it's dividends are fun to talk about, and they are emotionally charged.
Yeah, you talked earlier about price only indexes and how the Bloomberg terminal ships with a price only default. Can you talk about how common the use of price only index data is?
Yeah. So first off, just to make sure everyone's on board, a price index just looks at price changes, and a total return index puts a dividend back into them.
Right.
Which is super important because, as we've talked about, you know, in the prior segment, the price drops by the amount of dividends. We care about the total pot of money. You need to add the dividend back in. So it's important, and it's actually big. So, give or take, a third of market performance has come from dividends, about 2/3 from prices. You got to put them together. Now, in terms of prevalence, almost every major price index, almost every major market index that you see is a price index in terms of the default version that gets shown. So if you open the Wall Street Journal, the Financial Times, you want to know how the US market is doing, the S&P 500 you see, the Dow Jones you see, those are price indices. They ignore dividends. That's true with most international markets. The big exceptions are the DAX is actually a total return index that gets shown by default in the Brazilian Bovespa. Both are pretty modern indices. Now, the other thing that's a bit weird is kind of the right version of all these indices now exist. So if you Google S&P 500 total return, that will come up. But if you Google S&P 500, what comes up is the price index. You've got to actively search it out and find it. So we've talked a lot about salience. What is salient for almost every major index that you see? It's a price-only return index, not a total return index.
And why are price indexes so commonly used as a reference?
That's a very good question. I mean, particularly in a world where we've got the other version, right? Like we've got the version that's kind of calculated correctly. And, this is something, so this is from a paper with Dave Solomon, who's also at Boston College with us. We kind of dug into a little bit trying to understand what's going on. And I think it's largely historical accident. So think the Dow Jones. The Dow Jones, started as a railroad stock index in the 1880s. This was calculated with paper and pencil. And things like, keeping track of dividends and returns and things like that isn't particularly straightforward and easy to do. The S&P 500 dates back, I think, I forget it was the late teens, early 20s. Was like the initial index that became the S&P 500. And similar idea, like you've got some poor guy looking at tickers, calculating it by hand. And a price index, it is an approximation. But why are we still doing it? I think to a first approximation, because that's how we've done it. That's how we've continued to do it. Like, so why does Germany, the DAX, do it the right way? Well, so they used to have the Frankfurt index through, I think, the late 80s, and then they created a new index that became the DAX. And so when they created the new index, in a world with Excel and other type tools, they could calculate it the right way. But most of these indices are old. We keep doing it the way we're doing it. And I think it's just largely historical accident.
How does reference to price-only data affect the media's coverage of the market?
Yeah, so I think, what's interesting about a price index is that it is predictably and systematically wrong based on how high dividends are that day. So that Miller and Modigliani idea of the price dropping by the amount of the dividend, that works for firms, it holds for the market. So, let's say that the market is paying a dividend yield today of 1%. That means that if you were looking at the total return index, that number you were looking at would be 1% higher than a day with no dividend, because, you should be looking at it, you're looking at the wrong number. So what we show in our paper is we look at New York Times media coverage of the market, and we say, well, what is the media coverage reflecting? Is it reflecting the actual market performance, the total return? Or is it the fact that reporters are looking at the number that's like blaring right out in front of them? Because, again, none of this is secret. The real number is there. But what we find is that kind of financial coverage is significantly more negative the higher the dividend yield is, controlling for the actual level of performance, which intuitively makes sense. You're looking at the wrong number. You're responding to the wrong number. That's what coverage is actually responding to.
How does price return data affect fund flows?
So what we look at there is kind of how are mutual fund investors allocating money to funds. And a lot of mutual fund performance is benchmarked relative to things. But before going to kind of the wrong things that's out there, I should say there are now a lot of examples of the right things, of say total returns to a mutual fund, and total returns is an index that are out there. For example, Morningstar has switched over and is doing that, and a lot of other groups are following suit. But something that's still pretty common to observe is looking at the price of a mutual fund, kind of the change in NAV relative to the, say, S&P 500 price index. Now, this is now a bizarre mistake for a few different reasons. So one is, we shouldn't be using these price indices. We should be looking at total returns. But the other is that a mutual fund price avoids dividends, or sorry, doesn't include dividends, but also doesn't include a lot of other stuff. So, if you distribute capital gains, things like that. And so you've got, say, the wrong number for mutual funds, looking at the prices and not including the distributions, the wrong number for the market, but they're wrong in different ways, but they're commonly displayed next to each other. And so what we find is using this nonsensical benchmark that's commonly displayed, if you're a mutual fund who beats the S&P 500 price index based on your just shift in price, you end up with significantly higher inflows. So doesn't really make economic sense. It's the wrong benchmark, but it's commonly shown and people respond to it.
That's crazy. So that's like investors responding to not just performance, which is wrong in its own way because performance chasing doesn't make sense, but they're responding to the wrong performance metric.
Yeah. So people they like beating the benchmark, even if it's the wrong benchmark with the wrong performance metric. But the commonly displayed performance metric, and again, kind of common theme is people will look at what's in front of them without necessarily thinking too deeply about whether it makes sense or not.
Wow. I mean, I guess it sounds a lot like the sustainability ratings that we talked about earlier.
Yeah, no, exactly. It's like you've got something that's easy and out there, and so I haven't looked recently, but in the paper we have Yahoo Finance. What happens if you Google a fund? Well, it shows you the price path. And then what happens if you click, a benchmark and it graphs the price index? And it's really obvious for mutual funds because capital gains distributions can be big. And so you see these kind of big deviations. And that's because it's the wrong benchmark, but it's what investors see and they respond to it.
How does the prevalence of price-only index data affect the return expectations that investors hold?
Yeah, so there's this big puzzle in finance related to the equity premium, kind of like historically markets have returned this very high amount. Why is it the case that more people don't own stock? How has it been so high? Things like that. And so one, I think, aspect of this, which is consistent with this, not a whole solution by any means, is that people don't really realize how high the return to the market has been. And we said at the beginning that performance on the market has been about a third of dividends historically. So I think U.S. historical averages, give or take 8%. Annual returns, but if you look at, say, the S&P 500, it'll be about 5%, because that's the price only aspect. It kind of misses that chunk. And so if you're an investor and what you pay attention to, it's just how has the S&P 500 been every year? Well, you're going to look at a number that's systematically too low. And it leads to some interesting things. I think it's partially joking, but around the time of Brexit, there was, some news coverage along the lines that the Brits were just sick of the Germans having better performance than them every year on the market. And of course, the DAX was a total return index, and the UK indices were price indices. So the German, market basically has this, say, few percent head start every year and tended to beat them because they were just different numbers. But people perceived the German market to have higher performance just because the wrong benchmark was being used.
Incredible. So let's end this segment like the other two with some advice from you. What can people do to avoid being biased by is price index data?
So I think the good news with this one, relative to kind of the things we've talked about before, is the takeaway here is pretty easy, which is it looks like people are kind of looking at the price index, not really thinking about it and responding to it. And that's leading to bad, suboptimal behavior because they're looking at the wrong number. So how do you solve this? Well, you look at the right number. To the extent that you can, you should switch your defaults to total return indices.
Yep.
If you want to look at market performance, you should seek out these total return indices. Once you've got the right number in front of you, you can go ahead and just keep on ignoring the details, because now you're actually looking at the appropriate number, and you can respond to that appropriate number.
Yeah, that's good. Good
And it
advice.
would be good, I would say, that this one, to the extent that the default is changed, I think that would just be a societal benefit. Like the Wall Street Journal should be looking at total return numbers. Reporters should be talking about it. Brokerage statements should be showing it. This is just something that the default should be shifted to the total return metric. That would solve a lot of these problems.
All right, I want to move on to our last topic, which is one of our favorites, multi-factor asset pricing. And then
everyone loves multi-factor asset
Another
pricing.
crowd favorite.
How can you not? Can you talk about the theoretical explanation for why some assets have higher expected returns than others?
Yeah, so the rough answer is that some assets have higher returns than others in kind of standard asset pricing theory because of an insurance motive. So it's like, what do you care about in standard asset pricing is you want to consume, and you want to consume in the future. And you always want to make sure that you have enough consumption, you get all this good stuff, you have as much wealth, money as you can. So how do you go about doing that? Well, you think about the correlations with assets and kind of what's going to happen in the future. Is your house price going to go down? Are you going to be fired? Is the market going to, like, all of these sorts of things? And then you value assets more that have less of a correlation or an inverse correlation with those bad states of the world, because you like assets that will pay off when things are bad. So why is it that, say, stocks have a higher return than bonds? Well, because when bad things in the future happen, the bonds you think are going to be better insurance than the stocks. Because of that correlation, the price today of stocks will be lower, all else equal. That will lead to higher expected returns, which relates this belief about kind of future states of the world.
How do we know whether investors actually allocate their assets in a manner similar to the theory?
So I'd say there's kind of two different answers to this question. So the first is, look, if you assume that we've kind of talked through all of that intuition, but we didn't really mean it. It was just kind of some equations that we wrote down. This is what's known as kind of an as-if model. Like, people kind of behave as if this is what was going on. It doesn't really capture the motive. Then the answer is, we'll just take it to the data, see if it fits the data. The short answer, I would say, to does it fit the data in terms of those theories is no. There's now a very big literature that's really dug into, trying to build versions of these models to fit the data better, but it's very, very difficult to do. The second, and I think much more interesting version of this question is, we're taking this model seriously. So this model is really trying to capture the economic problem that investors are trying to solve. They really care about this motive. They really think about payoffs in that way. And if that's the case, I think the answer is, well, we need to go and talk to people. And we need to say, well, do you really care about this stuff? Is this how you're thinking about the world? Is this how you're investing money? And that should kind of tell you, is the model making sense or not?
How reliable do you think that type of surveyed data are for understanding people's asset allocation motivations?
So I think it depends. I think that there are certain questions that the answer is not very well. There's kind of subtle nuance, there's difficult things, there's people that do subconsciously, and clearly we can't ask people about those things. So there are very big limits to survey data. Now, with that being said, you think about kind of what we talked about in terms of asset allocations, fear of future bad states of the world, insurance motives, things like that. These aren't subtleties. These aren't nuances. These are like the first order obvious things, and that should be pretty easy to do. And so this is related to a paper I've got with Alex Chinko and Abby Sussman. And for example, in that paper, we ask some other first order obvious things. Like if you ask investors, do you like things with higher returns? They say, yes, please, with, T-stats of like 15. Like it is not subtle. Like people want higher returns. This is obvious. This is first order. Doesn't matter how you ask it. This like falls out of the data. If you say, do you like more risk? They say, no, not at all. They don't like volatility. Again, T-stats very high. Doesn't matter how you ask. But if you ask things, related to correlations, you don't find it. Now, this is a bit related to kind of this big debate with Milton Friedman, where he has this idea of kind of as-if models, like we're kind of building these as-if models. And he's got this famous example of a pool player who, goes, for a shot, and he's a professional billiards player. And Friedman says, look, he can't tell you the details. He just kind of rubs his rabbit foot for luck and hits the ball. And we can model him as if he knows physics and all these crazy equations. And I think a lot of economists would bring that up as an example for why surveys aren't necessarily very good. But actually, I think that example explains exactly why in this setting, you should be able to talk to people. Because like, think of a professional billiards player and go and talk to that guy and be like, are you playing billiards or basketball? Which ball are you currently trying to hit and why? What are the rules of billiards? Like the first order obvious things are first order and obvious and not very difficult to get at. And even if he, can't explain which muscle is twitching or, the nuance that is going on, if what's going on is kind of these first order obvious characteristics, it should be pretty straightforward to find that people care about this stuff.
What do your survey results tell us about asset pricing?
So almost every asset pricing that's been written down post kind of the late 70s, at its core has this insurance motive. So it's the idea that people deeply care about correlations of asset payouts in consumption. And actually, I don't even know if I've mentioned it, but like the big takeaway in the paper is, look, people care deeply about means, people care deeply about volatilities, and we show massive swings to this insurance motive, and nobody cares whatsoever. We show a bunch of experiments showing that. We show versions of kind of open-ended prompts where we can say, write down a paragraph about what you care about. Nobody mentions it. It does not seem to be a kind of aspect of this decision in any meaningful sense. And that says that our asset pricing models are basically, missing something fundamental. They're kind of putting in something artificial that shouldn't be there is the first bit. And then at the same time, they're clearly missing something, because just like kind of taking these things on their own, you can't explain, like mean and vol alone can't explain asset returns. That's why things shifted to this kind of correlation idea. So, this is something that maybe people should be thinking about, but asset prices are set by what people are actually thinking about. And so it suggests that trying to explain asset prices with this kind of, correlation hedging motive as a core concern isn't likely to be a successful endeavor. And what the field has done is to take this core idea and layer further complexities on top of it. So, you care about, the initial one is you care about correlations with consumption. Well, that didn't work. So then you put an interaction of that with another state variable and another thing in a more complicated way. And each of these is just, you care about this core concern in a more complicated, more nuanced way. And given that the first order thing isn't there, the kind of second and third order complication seems not particularly likely to explain anything.
What do you think of the implications for people pursuing higher expected returns with their portfolios through tilting toward these priced risks?
Yeah, so I think it definitely shifts the potential interpretation of these risk factors. So, let's take value, for example. Let's ignore the debate about like, is value gone? So let's say historic, we expect value to outperform. Should I invest in value? Well, the consumption-based kind of version of that you would say from the standard models is, well, look, how do your kind of risks and correlations compare to the market? Because value is there, but it's there because it represents a kind of systematic, unhedgeable risk. And so maybe if you aren't as exposed to this as somebody else, it could be a good thing for you to hold some value. Now, about half the people you talk to, you should have the conversation, look, value outperforms, but given your correlation with risk, you actually have a little bit more of a loading on kind of this value risk paper. You should be buying growth. I think in practice in industry, those conversations don't tend to happen that way. And you guys probably know much more about that than I do, but it's like most value, investors aren't talking about correlations with systematic risk. They're talking about outperformance. And they're saying, look, this is alpha. Isn't alpha kind of a great thing? And so, I do think that it makes it much less likely that what's going on in these risk factors is a systematic correlation with an underlying systematic risk. In the paper, we do a version where we kind of ask about that explicitly, and we find that people don't think about it in that way. I think that's kind of the main implication there.
You're right that those conversations aren't happening, at least from what we see. But you made me feel a lot better because I felt very guilty about not having those conversations ever since we talked to John Cochran.
Did John guilt trip you into?
He wasn't a guilt trip, but I mean John Campbell too. They gave us very strong explanations of the hedging motive and exactly what you just said, that maybe some people should be tilting toward growth. So then we've been thinking about, how do we have those conversations? Who should actually be tilting toward growth? But yeah, anyway,
yeah,
now I don't feel as guilty.
So I think that was a belief. So like kind of the value literature, I'd say, really grew up kind of in the late 80s and the 90s. And, this is long before I was a professor, but talking to people who were around then, I think the discussion was, look, we found this predictor of returns, especially in that period, markets were viewed as quite efficient. And so clearly there was a systematic risk that this was responding to, and people didn't understand what it was at the time, but they were quite confident that they would have a good answer moving forward. And, kind of now 30 years later, a number of things have kind of been mooted. Most of them, I think, have kind of been discarded. And it's very unclear what systematic risk value could be providing compensation for. And I think that's another, all of these stories about, efficiently priced risk and return mispricing. Yeah, okay. So the base intuition of our survey is that, where there's return predictability in terms of compensation for risk, these shouldn't be mysteries. Like these should be obvious, straightforward things. And in many ways, the academic who writes the paper showing the return mispricing is the last person in the world to find out about this. So what would value be in a rational risk factor type intuition? Well, it would mean, look, for the last century, people have viewed these assets as kind of having correlations of a certain type based on, whatever that systematic risk is. Prices today reflect that future motive in a knowing way, right? Like, if you are going to say hedge oil prices because you're Southwest Airlines, and someone goes and says, why are you buying these futures contracts? You're going to say, because I'm hedging oil prices. Like it's obvious, it's straightforward. I'm paying to do that today. That's what should be going on with something like a risk factor with the value premium. But that doesn't seem to be what's actually going on. People have not been able to tell us why it is this is there. People have been surprised about these empirical facts. And whenever kind of there's systematic surprise about return predictability, that seems much more consistent with a mispricing story than a risk factor type story.
Yeah, it's crazy. We talked to Adriana Robertson about this too, and she'd done a survey with, I think, fairly similar, at least on this part, results. Crazy stuff. And when we've had those, we've had guests or we have talked about the hedging motive. We talked about the ICAPM in an episode, and a lot of our podcast audience, a lot of the response was like, well, I don't think people actually think that way. Like, I think if you ask somebody why they invest in a growth stock, it's not because they're hedging, it's because they think it's going to have higher returns.
Oh yeah. Well, and, the other thing, go and we can also just like kind of read what happened in the past, right? It's like go and read Graham and Dodd, like the father of value investing. And they aren't saying, look, this is an appropriately priced risk factor. Like they're saying, look, through careful research, you can find underpriced stocks. And in modern language, like they're going to have alpha because they're mispriced. That seems to, be what most people think they're doing in value investing.
Super, super interesting stuff. That was awesome.
So our final question.
I don't know, fun. That was a fun paper. We hit a lot of interesting things and a lot of deep thoughts about asset pricing models, which was fun to think about, fun to do, fun to present, a lot of different opinions. So
I bet.
It's good.
Cool. So our final question, which is a fan favorite, much like dividends. How do you define success in your life?
So you shot me this question, and it's a very difficult one. And it's one that I kind of wish that I thought more about in the moment. So I've got a 6-month-old at home, so my time for deep reflection has not been as copious as I would like. But so I'd say the first thing that I've come to, I'd say as life has gone on, is that I think my definition is less about concrete goals. So I think my 18-year-old self would have really focused on things, you want to achieve X, or you want, I don't know, a certain amount of money or certain like that. But I don't know, life throws curveballs, life's changing, life's uncertain. And so as much as possible, I think I'm now kind of focusing on more concepts and broader goals that are, I think even if life changes, even if things are different, are still things that are achievable and are important and kind of hold throughout those different things. So with that said, it's I was trying to think of a non kind of cheesy way of talking about broad goals, and I don't think I can. It's I've got these young kids, so I really want to be a broadly defined good father and a husband. Broadly defined, I would like to that I don't know, others consider me a good person and that I treat people fairly, things like that. I'm very much an educator, so I hope that I can actually help people, in some small amount, to educate them to make better decisions. I think finance is important, for not just for hedge funds and alphas and things like that, but hopefully I can help people in some small way, I don't know, make better retirement decisions or do better in their portfolios, and have some fun doing it. So hopefully do some things I find intellectually satisfying, and kind of enjoy the ride as it goes. So yeah, I don't think I was struggling for something more concrete, but I think that was about the best I could come up with these days.
It's a great answer to the question. This
Thanks.
has been great, Sam.
It's a really good question. I now I want to go back to your other podcasts and kind of see what other people. That was the other thing, is I didn't want to cheat, so I felt like I totally could have gone and, like, looked at the last thing of like 20 of your podcasts and collated the most awesome answer, but I didn't do that.
Oh, your answer was great. All right, Sam, that's it. This has been awesome. We really, really appreciate you coming on the podcast.
No, this has been an absolute blast. And I mean, thank you guys again for spending the time to go through all the papers and come up with these great questions. It's totally my pleasure to chat and do this. So, anytime. This is great.
Awesome. Thanks, Sam.